imagine you walk into a classroom to, learn a completely new profession, but you find out that like 80% of what the teacher's about to tell you is mathematically engineered to make you go broke.
Right.
You would walk right back out, wouldn't you?
Yeah, absolutely.
Yet, that is exactly what happens to millions of people every single day when they open up a social media app looking for trading advice.
Yeah.
You're just instantly bombarded by some 22-year-old standing in front of a leased sports car pointing at a chart that looks like a neon spaghetti monster.
Oh, the spaghetti charts.
Right. Promising that if you just, copy their secret strategy, you'll be retiring by next Tuesday. It is just a constant, overwhelming flood of algorithmic hype.
And the thing is, it is incredibly effective because it preys on a very natural, very desperate human desire for financial independence. But the gap between that flashy content and the grim reality of the retail trading failure rate is, well, it's massive.
Which is exactly our mission for this deep dive. We are going to cut right through that viral noise and, separate the illusions from actual data-backed financial strategies.
Right.
We're grounding this entire conversation in a really comprehensive breakdown by a financial educator named Jerome. He's the founder of a program called TreesSX PRO.
Yeah, it's a great piece.
It is. And he recently published this guide that cites real trader data, extensive Reddit community testing, and this scathing new April 2026 report on the state of financial social media.
So, okay, let's unpack this because the methodology in that April 2026 report is honestly genuinely terrifying for anyone trying to learn how to navigate the markets online.
It really is. The researchers who put together this April 2026 report essentially placed the entire FinTech ecosystem under a microscope.
Wow.
They didn't just watch the videos, they actually analyzed the underlying claims against historical market data.
Yeah.
And the results are an absolute indictment of the space.
Like, how bad are we talking? Well, according to their findings, 80% of viral finance videos on TikTok are fundamentally misleading.
80%.
8 out of 10 videos. They're pushing narratives that are statistically false, impossible to replicate, or just dangerously incomplete.
I really want to dig into how they came to that 80% number because the report actually handed out grades based on specific criteria, right? Like, what does a failing grade actually look like in this context?
So they evaluated these videos almost like academic papers, looking at things like the disclosure of risk and the accurate representation of market mechanics.
Okay.
When it came to providing adequate risk warnings, 60% of the videos received an absolute F.
Wait, 60% got an F in risk.
Yeah, and we have to remember, in trading, risk management is literally the only thing keeping you in the game.
Right.
And it gets worse. When graded on oversimplification, 70% scored a D or below.
Oh, I can picture exactly what a D in oversimplification looks like. It's those videos where someone's like, just draw a line here, wait for the green arrow, and use 100x leverage.
Exactly. Yeah.
They take something as incredibly complex as global market dynamics, which involves central bank policies and massive institutional algorithms, and they reduce it to a push-button slot machine.
And the researchers pointed out this massive, glaring omission in almost all of these videos, which is the concept of drawdown.
Drawdown, yeah, that's a big one.
Right, because drawdown is the terrifying math of how much your account balance bleeds from its peak during a losing streak before it recovers. A viral video will boast about like a 90% win rate strategy, but they entirely fail to mention that the strategy requires you to sit through a 50% drawdown.
Wow.
If your $10,000 account drops to $5,000, your brain goes into panic mode. You just abandon the strategy entirely.
It's like those flashy viral diet fads.
Oh, exactly.
They promise you a six-pack in 3 days if you just, drink this weird lemon water concoction. But the underlying mechanics of human biology mean you just end up sick, starving, and honestly further from your goals. But if this information is so demonstrably bad, why does the algorithm push it so heavily?
Because social media algorithms do not care about your financial well-being.
Right.
And they certainly don't care about statistical accuracy. They reward watch time, engagement, and dopamine.
Just keeping you on the app.
Yeah. A nuanced 20-minute video explaining the mathematics of drawdown and position sizing is, well, it's boring to the average user.
Sure.
But a 15-second video shouting about a 1,000% gain on a meme coin, that triggers immediate excitement, so the system systematically suppresses cautious, realistic education.
Which directly leads to new traders blowing up their accounts within like weeks.
Yeah.
So if 80% of this ecosystem is a trap, where do serious traders actually look for the antidote?
The antidote, as Jerome points out in his breakdown, is grounded, community-tested data. It's about moving away from the flashy, cherry-picked trades and actually looking at thousands of logged, verified setups. His guide specifically focuses on 3 classic market behaviors.
Not secret cheat codes.
No cheat codes, just visual footprints of human psychology playing out on a chart. And what's crucial is that these behaviors have actually been proven to work, boasting win rates between 58 and 71%.
That's solid.
But, and this is a huge but, only when executed with an almost ruthless level of mechanical discipline.
Let's get right into the mechanics of that. I want to trace the narrative of how a trader actually reads the mind of the market, so to speak. And Jerome starts by looking for a massive, undeniable shift in momentum. Let's talk about the bullish or bearish engulfing pattern.
Yeah, the engulfing. Visually, it is exactly what it sounds like. Let's say you are looking at a chart where each candle represents 4 hours of trading activity.
Okay, 4-hour chart.
Right. You have a small candle showing that the market is gently moving in one direction. Then the very next 4-hour candle completely engulfs or swallows the previous one, moving the exact opposite direction.
Oh, I see.
So a small green up candle is followed immediately by a massive red down candle whose physical body completely covers the space of the previous green one.
So it's not just a subtle change of direction. It is a total violent rejection of the previous sentiment.
Yes, exactly. The buyers were in control, making a little bit of quiet progress, and then suddenly a massive wave of sellers steps in and entirely overwhelms them, dragging the price down so far that the previous 4 hours of buying look like a rounding error.
Wow.
According to the data aggregated in Jerome's report, this specific shift boasts a 58 to 67% win rate when traded correctly.
Okay, wait. I'm a bit confused about the traded correctly part.
Yeah.
Because the source was very specific about the setup rules, particularly about waiting for the candle to close. If I'm watching my screen and I see a massive green candle shooting up, clearly engulfing the previous one, why can't I just jump in right then to catch the momentum? Like, why do I have to wait for the 4-hour clock to strike zero?
Because that is the exact trap that destroys amateur traders.
Really?
Yeah. What you are describing is trading a moving target. Institutional players, the massive banks and hedge funds that actually move the market, they know that retail traders are impatient.
Right.
They will intentionally push the price up rapidly to trigger your fear of missing out. You jump in, thinking it's an engulfing candle. Then, in the final 5 minutes before that 4-hour period ends, the institutions pull all their money out and sell.
Oh, no.
And the price plummets back down.
And that leaves what traders call a wick.
Exactly. The body of the candle shrinks down to nothing, and all that's left is a long, thin line, a wick showing where the price used to be.
Just a ghost of the momentum.
Right. If you jumped in early, you are now trapped at the worst possible price, and the pattern you thought you saw doesn't actually exist on the close chart. Waiting for the close is the ultimate filter for fakeouts.
That makes total sense.
Oh, yeah.
And there's another filter the guide mentions that I want to highlight because Jerome is adamant about it. That's volume.
Yes, volume is huge.
The volume on that engulfing candle must be at least 1.5 times the recent average. Why is that specific 1.5 multiplier so critical?
Because a large candle on low volume is basically just a hollow shell. It means the price moved easily because nobody was actually participating.
Okay.
But a large candle on 1.5 times the average volume proves that heavy institutional money has actually stepped into the market. They are throwing their financial weight behind that new direction.
And the source backs this up with hard data, too. There's a specific case study from the R4X subreddit highlighted here.
Yeah, that Reddit study was fascinating.
It really was. One trader meticulously documented a 67% win rate using this exact pattern, combined with that volume rule, on a 4-hour Forex time frame. And this wasn't just a fluke weekend either. This was across 347 trades over a 6-month period.
Which is an incredibly robust sample size in the trading world. It proves the edge is real.
But here's where it gets really interesting to me. Think about the sheer psychological endurance required for that Reddit trader's strategy.
Oh, yeah.
A 4-hour time frame means you are waiting 4 hours just for one single candle to form. And you have to wait for it to close.
Yeah, sitting on your hands.
Literally. You might be sitting there for 3 hours and 59 minutes doing absolutely nothing, just waiting to confirm the shape of a box on your screen. That requires a level of stoicism that a hyperactive 15-second social media feed completely obliterates.
It requires you to be a sniper, not a machine gunner.
Yeah.
The algorithm hates patience, but, well, your brokerage account relies on it.
It's so true. So we've looked at recognizing a massive, sweeping wave of momentum. But the market doesn't always move in sweeping waves, right?
Definitely not.
Sometimes it just hits a brick wall. And that brings us to the second behavioral footprint Jerome focuses on, which is the pin bar.
The pin bar, yes, sometimes referred to as a hammer. It's arguably one of the most famous patterns, and the data puts its win rate between 61 and 69%.
Okay, so higher win rate than the engulfing.
Yeah. Visually, it is the exact phenomenon we were just talking about with the wicks. It's a candle with a very small body, but a massive wick on one side. The strict rule is that the wick must be 2 to 3 times the size of the body itself.
It's exactly like touching a hot stove.
Yes.
You put your hand down, realize instantly that the metal is burning you, and you violently yank your hand back. The market drops to a specific price, feels the massive heat of all those opposing institutional buy orders, and just recoils.
And to build on your hot stove analogy, that long wick represents the physical space where the market got burned.
Oh, I like that.
It is a graveyard of traders who tried to push the price further, only to be instantly overwhelmed by the other side. The longer the wick, the more dramatic and significant that rejection is.
But just like the hot stove, it matters entirely where the stove is located, right? If you see a pin bar just floating in the middle of random sideways price action, it doesn't mean much.
Right, context is everything.
Yeah, and Jerome's guide points out that this only works when it interacts with a known boundary. And that brings us to a specific strategy that the Reddit communities rave about: the pin bar plus the moving average bounce.
Exactly. This strategy combines the raw psychological rejection of the pin bar with dynamic support. Traders wait for the price to pull back to a major moving average.
So physically, the 50 or 200 EMA, which stands for exponential moving average.
Yeah.
I want to pause on the EMA for a second because we hear that term thrown around a lot. Why do millions of traders, and more importantly, why do multi-billion-dollar algorithms care so much about this specific invisible line on a chart? How does a dynamic average act as a physical barrier?
It is the ultimate self-fulfilling prophecy. An EMA is just a mathematical formula calculating the average price over the last 50 or 200 periods weighted toward recent data.
Yeah.
But because it is universally tracked, institutional trading bots are literally programmed to execute buy or sell orders when the price touches that exact mathematical average.
Wow, really?
Yeah, so it's not a magical line. It is a highly populated intersection where thousands of automated computers are waiting to do business.
That is wild. So when the price drops down and touches that 200 EMA, and you see a pin bar form right at that intersection, rejecting the line and leaving a long wick, you are literally seeing the institutional bots turning on and pushing the price back up.
Precisely. You're watching the big money defend their territory.
And what are the rules for actually trading that?
The execution rules are highly systemic. You enter the trade only when the price breaks the high of that pin bar.
Okay.
You put your stop loss safely below the lowest point of the wick.
Because if it goes lower, the big money gave up.
Exactly, the institutions have surrendered. And then you target a 1 to 2.5 risk-reward ratio.
Makes sense. Okay, so we've looked at an impulsive momentum shift with the engulfing and a hard, sudden rejection with the pin bar. But what about when a trend doesn't end with a bang, but just sort of slowly runs out of gas?
Yeah, exhaustion.
Right. That leads us to the third pattern in Jerome's guide, which actually boasts the highest success rate in the data: the morning star or the evening star.
This is a 3-candle sequence, and the data puts its win rate between 63 and 71%, which is exceptionally high.
71%? That's huge.
It is. Let's use the bullish version, the morning star, as an example. It happens at the bottom of a long downtrend.
Walk us through how this exhaustion actually plays out on the chart.
So the first candle is a strong, heavy red candle. The sellers are still firmly in control, pushing the price lower.
Okay, standard downtrend.
Right. But then the second candle forms, and it's tiny. It's an indecision candle, sometimes a perfect cross, where the opening and closing prices are exactly the same. Neither buyers nor sellers made any ground. The downward momentum has completely stalled out.
Like a car that just sputtered and rolled to a stop.
Yes, exactly like that. And then the third candle confirms the reversal. It's a strong green candle that surges upward, closing well into the physical territory of that first red candle.
Got it.
So the sequence is aggressive pushdown, total stalling out and indecision, followed by an aggressive explosion upward in the new direction.
And the execution rules from the source are just as rigid here, I assume?
Oh, absolutely. You must wait for that third candle to completely close. Your protective stop loss goes below the absolute lowest point of that middle indecision candle, and you target a minimum 2-to-1 risk-reward ratio.
2-to-1?
Correct. It is a highly conservative entry because you are requiring the market to prove to you over 3 separate periods that the trend has fundamentally changed before you risk a single dollar.
Okay, I have to play the skeptic for a moment here.
Sure.
Because you were throwing out numbers from this report like a 67% win rate, a 71% win rate.
Yeah, they're big numbers.
Let's be real. If I could walk into a casino and win 71% of the time, I would own the entire casino by Friday.
Well, yeah.
So if these behavioral footprints are this effective, and the data proves it, why isn't every single person who reads Jerome's blog post sitting on a private island somewhere?
Well, what's fascinating here is that your skepticism hits on the exact core of why trading is the hardest way to make easy money.
Okay.
The patterns are just tools. Like, a scalpel is an incredibly effective tool, but if you hand it to someone who hasn't been to medical school, they're going to cause a disaster.
Good point.
The reason 90% of retail traders fail isn't because the Morningstar doesn't work. It's because of the terrifying things that happen between the trader's ears.
Ugh. The psychology. The unspoken rules that FinTech absolutely refuses to talk about because it ruins the fantasy.
Exactly. To actually extract those 60+% win rates from the market, you cannot just look at a shape on a chart in isolation.
Right.
Successful traders combine these patterns with multi-timeframe analysis.
Let's explain how that actually works in practice. Because I know it's a big part of the report. What does multi-timeframe analysis do for a trader?
Think of the market like an ocean. The daily chart tells you whether the overall tide is coming in or going out.
The big picture.
Right. The 1-hour chart shows you the individual waves. If you find a beautiful bullish engulfing pattern on a 1-hour chart, but the daily chart shows a massive catastrophic downtrend,
You're in trouble.
you are basically trying to surf a tiny wave while a tsunami is coming from the other direction. You will be crushed. You only take the trade when the wave aligns with the tide.
And even more importantly, they employ ironclad risk management. The source explicitly mentions risking only 1 to 2% of your total account maximum per trade.
Yes.
Think about the reality of that. If you have a $1,000 account, you are only risking $10 or $20 on a setup.
Which is profoundly boring to a social media user who wants to double their money by tomorrow.
Yep.
But risking 1% ensures that even a horrible streak of 5 or 6 consecutive losses, which, by the way, is a mathematical certainty eventually.
Right. It happens to everyone.
We will only draw your account down by 6%. You live to trade another day.
But people don't do that because the environment they are learning in actively discourages it.
Totally.
Jerome's guide outlines 4 fatal traps that destroy these accounts. Over-leveraging, which is borrowing money from the broker to make dangerously large bets. Over-trading out of sheer boredom because sitting for 4 hours waiting for a pin bar to form feels like doing nothing.
It does feel like nothing.
Right. Refusing to adapt when market volatility changes. And then the most dangerous, insidious trap of all, revenge trading.
Ugh, revenge trading. It is the ultimate account killer, and it is deeply, fundamentally human.
How does it start?
Well, you take a perfectly good trade, you follow all the rules, and you still lose.
Because it's probabilities.
Exactly. But your ego is bruised. And instead of accepting it as a simple statistical probability, you get angry. You feel like the market stole from you.
Oh, I've been there.
We'd all have. So you immediately jump back in, usually with double the position size, abandoning all your rules, just trying to force the market to give you your money back.
Yeah.
But the market does not care about your feelings, and it will take the rest of your money without blinking.
And this is where we have to connect the psychology back to the social media platforms themselves. How does the user interface of these trading apps and social feeds actually trigger that revenge trading?
It's the gamification. When you open these apps, you are greeted with flashing green and red numbers, push notifications, sometimes literal digital confetti when you execute a trade.
It's insane.
It is designed by the same behavioral psychologists who design casino slot machines. It keeps your nervous system constantly elevated.
Constantly in fight or flight.
Right. And when your adrenaline is spiking, the logical part of your brain, the part that remembers the 1% risk rule, it just shuts down. You are reacting purely on emotion.
You're trying to punish the market, but you're only punishing yourself.
Precisely.
This is exactly why Jerome emphasizes boring, rigorous education as the only real antidote. He actually points people to resources that focus on the grind, not the glamour.
Yeah, I love that part of his guide.
Right. Things like a $3 candlestick mastery guide that strictly breaks down these risk frameworks, or his free live chart analysis classes on Google Meet where he just shows the work.
In real time.
In real time. There are no Lamborghinis in the background, just a guy analyzing institutional data.
Which is exactly what is needed to combat that lottery ticket mentality. He is treating trading as a high-performance profession, not a casino game.
So what does this all mean? When we zoom out and put all of this together, from the terrifying 80% failure rate of FinTech advice, to the mechanics of institutional algorithms defending the 200 EMA, to the psychological devastation of revenge trading.
It's a lot to take in.
It is. It means that success in the markets isn't about finding a magic secret shape on a chart. The patterns are just the entry criteria.
Right.
Real success is about using data-backed frameworks to manage your own flawed, impulsive human emotions. It's about recognizing that you are your own worst enemy.
Yes, and not only that, but realizing the market is just an incredibly expensive mirror reflecting your own level of discipline back at you.
Well, thank you all for joining us on this deep dive. I think it's clear that true financial literacy requires patience, it requires intense discipline, and above all, it requires a willingness to look past the algorithmic hype that is constantly trying to sell you a shortcut.
And if I could leave you with one final, lingering thought to mull over today, based on everything we've looked at regarding the psychology of these platforms,
Please do.
think about the social media apps we use to consume our financial news. They are fundamentally engineered by algorithms designed to reward height, to heavily gamify our attention, and to trigger impulsivity. Those are the exact same three behaviors that cause 90% of retail traders to blow their accounts. So you have to ask yourself a very uncomfortable question. Is it even possible to safely learn trading on these platforms? Or is relying on a viral algorithm for financial education inherently at war with the very discipline required to survive the market?
It's like trying to learn about healthy nutrition while locked inside a fast food restaurant.
Exactly.
You might find a single salad on the menu, but the entire environment, the smells, the lighting, the advertisements, everything is meticulously designed to make you eat the fries. Until next time, stay curious, respect the data, and protect your capital.